advisory and consulting firm serving corporate and not-for-profit retirement programs and individual investors. We anticipate our discussion today will finish in 30 minutes. All attendees are on mute. And please feel free to ask questions through the questions tab, and we will answer as many as possible. If we do not get to your question, we will follow up after the presentation. A recording of today's webinar will be accessible through the Finspire channel on YouTube. Today's webinar is a socially distanced chat with Brad Pineault, chartered financial analyst and capital market strategist with Fidelity Investments. Brad is an expert in the intersection of where the current public health crisis meets the capital markets. Brad, welcome. We are thrilled to have you join us today. Brad, amazingly, as of the close of business yesterday, the S&P 500 has a positive total return year to date. That's not a joke. It was a stomach churning ride down and a rapid recovery. So let's get to our first poll question before we proceed with the rest of today's program. All right, poll question number one. What is your best guess as to where the stock market is today? Is it too high, too low, or just about right? Okay. Give you a couple more seconds to answer. This is pretty good. All right. So take a look at the results here. Interestingly, the too high and just right were tied for the lead, and too low. So good. We've got a couple optimists in the group. That's great. And at 14%. So too high and just right, basically is, I think, the sentiment that we know that a lot of the people and investors that we speak with on a regular basis have shared with us. They're a bit confused about what's happening out there, justifiably so. So Brad, let's jump into it. We continue to learn more about COVID-19, but perhaps relative to other outbreaks, it carries greater uncertainty about its direction. What do you make of the modeling of this virus and what the future holds for it?
Well, you bet, Chris. And thank you as well. I actually had myself on mute, and I realized that I said thanks for including me here today, but I think it fell on deaf ears, or at least muted ears. With that being said, really appreciate the opportunity to speak to your clients. And, as much as this poll is indicative of perhaps the temperature check out there in the marketplace, that the market can continue to go higher. And certainly we would concur, maybe getting right to the punchline right up front. Just the very fact that the market is perceived to be high doesn't mean that it can't continue to go higher. But to your question here, it is all virus dependent, right? If you really think about why the market's done well, one could argue that the elements for this pandemic are becoming better. We're certainly not out of the woods, as one would say. And here at Fidelity, we're doing as much work as we possibly can on perhaps the pathway forward. So what I've done here is I've advanced the slides to a number of these elements around this pandemic. And what's interesting is when you look in history at pandemics or just virologic outbreaks, they could even be epidemics or, a bit of a smaller virus, if you will, they do have an evolution to them. There are these endpoints that we should all look towards to understand if things are better, the same, or worse. And we're going to cut right to the chase and say that things are better, right? They're not good, perhaps, around this virus, but they are better. And one could argue that the elements that governors are looking for and public health officials are looking for, social distancing, will continue. We've seen all of these proposals for restaurants reopening, schools getting back in the fall, sporting events locally. Social distancing will continue to be one of the hallmarks of any pathway forward. Whether people like it or not, that certainly seems to be better than worse until we, perhaps have some type of cure or major medical solution. In addition to the social distancing, we know that testing is something that we are going to need to see more of. Now, the good news here is state by state, we are conducting more testing. The testing is allowing public health officials to better ascertain or understand where these hot spots of the virus lie, right? Almost down to the zip code. We've made some major strides, we being the United States. Back in early April, the testing was highly inadequate for multiple reasons, but today that's no longer the case. And so not only do we have a higher prevalence or quantity of testing, but the quality of testing, the efficacy, the efficiency of the testing is definitely night and day from where we were just 2 months ago. So that is a real positive. And then lastly, the progress in treatment. There's so much we could say here, Chris, in terms of the continuum of the medical solution. The end all be all is this special word vaccine. There's a lot of opinions here, a myriad of opinions as to when a vaccine could be a reality, right? Especially on a mass scale. I've heard ranges anywhere from 6 months out, something in the latter part of this year, to 2 years. I think 6 is optimistic, 2 is pessimistic, probably a happy medium. Early next year, we'll have some type of vaccine. The facts around a vaccine, as far as a longer term solution, are that there are nearly 100 different vaccines in play right now. Without a doubt. And there's a dozen or so that are in at least phase 2 in terms of human trials. So this all bodes well for perhaps sooner rather than later. And like I always say with a vaccine, Chris, it's not a matter of if we have one, it's really just a matter of when, right? So it's just a matter of time until we get a vaccine. The good news is on the front end of progress and treatment, we are starting to see more and more medicine be created or repurposed for the treatment of the severely critically ill for COVID-19. Not a silver bullet, right? This is still a fluid and uncertain situation, but 2 months ago, we had almost no medicine to treat. We had more questions than answers around how to treat this virus. And now, as I mentioned, not out of the woods, but certainly better progress in treatment is a good thing. And the last thing I'll say around the virus is warmer weather and contact tracing. These two elements, warmer weather, for what it's worth, it's not so much that the temperature of the air that human beings breathe in is mitigating the transmission of a virus. We actually have found, based on our scientific research, it's more ultraviolet light. So just being in the sunshine helps to mitigate any virus, and COVID-19 is no exception. So that's a good thing. The northern hemisphere of the planet is seeing more daylight, right? The sun rises early 5 a.m. and doesn't set till 9 p.m. depending on where you live here in the States. But that bodes well for at least the slowdown in terms of number of new cases. And then contact tracing. This one's probably controversial, right? Some people feel like there's no way you're going to get me to give up my quote unquote privacy. But in a matter of public health policy, contact tracing is certainly an effective pathway forward. If we do get outbreaks, we'll have better information, greater transparency, just like the testing side of things, which again, should help mitigate the loss of human life. So that's how we think of the virus. Again, to summarize it, Chris, things are better here in the middle part of June than they were in the middle part of March. And that is a real significant reason why this market is appreciating. This virus will eventually abate, as they say.
Yeah, Brad, I like what the phrase you used there, not good, but better. And that very well could be, could come back to us along the way throughout this presentation in a variety of ways.
Yes.
So on the bottom of your pie there, you have a monetary stimulus notch, and the government has been extremely busy. They've acted very quickly, especially when you compare, say, when you compare the economic impact of COVID-19 versus, say, the mortgage and financial crisis of 08-09. The government was extremely assertive right out of the gate with both fiscal stimulus from Congress, putting trillions into the capital markets, and then the Federal Reserve also injecting trillions into the capital markets. They acted extremely quickly. Some of these are shorter term in nature, but what should we look for over the longer term with those two elements of your pie there?
Yeah, I appreciate you bringing those up, because if you were to say, well, what's the second reason why this market has recovered as quickly? Well, clearly, in addition to this virus getting better, right, not worse, this stimulus here has been, quote unquote, unprecedented. You know, sometimes we use all these words in our daily vernacular. If you look up that definition of unprecedented, real simply, Webster's would tell you never been done before. And while the federal government has certainly stimulated, quote unquote, with fiscal stimulus in the past, and certainly we've seen the Fed, you know, for 75 years stimulate intermittently from time to time, what they've done this time around has never been done before, just in sheer magnitude, right, i.e. the amount of money, and secondly, how quickly this has all come together. And I'll just be brief here, Chris. If you think about monetary stimulus, this is where the Fed Reserve, right, the world's largest bank, plays a lever pulling role. And we know that monetary stimulus conventionally has just been interest rates going up and down. If the old saying goes that if you can lower interest rates, people are more incentivized to borrow, and it would cost them less to do so. Same thing for corporations, and that stimulates an economy. Well, 12 years ago, when Ben Bernanke was the Fed chief with that last recession, they kind of unveiled this new policy called, you know, if you think about it, quantitative easing. And not to go too deep here, all that meant was that the Fed Reserve was going to stop buying up financial instruments, mostly United States Treasury bonds. And as they did that, the more you buy something, it goes up in price. And sure enough, the way bonds work, the yield came down. So that further brought down the interest rate environment, which further allowed for the economy to get better. Well, 12 years ago, it took some time to do that, right? Months. This time around, it literally took days to actually do that. And if you think about how much we did back in 2008, one would argue that we're doing about 4 times the amount today from a monetary perspective. Around $6 trillion has been allocated to this component of stimulus. Monetary is somewhat invisible. You know, the average person, the average investor, anybody on Main Street, if you will, wouldn't really see monetary stimulus. But I can just tell you, it's out there, and it's been fast and vast. Fiscally, this one's a bit more tangible, right? This is where the U.S. Treasury, via the United States Congress, both Republicans and Democrats, right, went ahead and cut checks and sent basically refund checks that you don't have to pay back, that are not taxable. And that was stimulative, right? I mean, depending on your income, a lot of people got those checks. They also allowed for greater unemployment insurance, right? That would be fiscal stimulus. So this one you can touch, you can feel, you can actually see the money in your bank account. That very bipartisanly, Democrats and Republicans, again, very quickly get together, and they have so far approved $2.5 trillion of stimulus. Again, never been done before. When you put those two together, $8.5 trillion, and if you had to be a bit thoughtful, that's about 41% of the United States GDP has been allocated to stimulate the economy. Now, Chris, I want to be fair here. Stimulus to me is above and beyond, right? If something is stimulative, that's it's obviously going to be a positive catalyst. The economic damage, right, to this, and I think we'll talk about that, has been pretty deep. So perhaps this stimulus has been nothing more than a bridge the gap, someone once told me it's a liquidity band-aid. But the Congress is now talking about a fourth round of quote unquote stimulus, and that most likely will be above and beyond, meaning this could further perpetuate this economy to a better scenario. But this, again, unprecedented, and we should not underappreciate just how substantial and how quickly we've gotten this money to help things.
Yeah, that's really interesting. The invisible nature of some of the, especially in the monetary side, where people are starting to see that as perhaps a little bit of a return in the wealth effect potentially, but it still is very hard to quantify and make it tangible in people's everyday lives. So as we transition here to get a little bit more into the economy, I want to raise our second poll question before we transition into some of the economic impact and really where we stand. So what you'll see here is the second poll question. How do you feel the economy is doing today relative to how you felt at the beginning of the pandemic? Doing better than I thought, doing worse, about what I expected, or just have no idea? All right, very good. The answers are piling in here. Okay, good. Yeah, 50%, Brad, saying that the economy is doing better than they thought it would. And you have another distribution, couple saying doing it worse than I thought it would, about what it expected, about as expected, 25% uncertain how the economy is doing at 15%. I'm wondering, yeah, it's really interesting results here, especially here with many people participating in the call in the Midwest here, where we have, especially similar to the situation in the Northeast, Brad, where we have pretty significant lockdowns in various parts of the Midwest here. So I think that's a pretty favorable figure there, favorable results.
Pretty great.
Yeah, it's good. The virus you mentioned clearly, and I guess it became official today, right, or yesterday, Brad, that we are actually in recession. It spread into it. This has actually, triggered a deep, potentially brief, however, recession. I know that the Atlanta Fed has something called the GDP Now tracker, and indicates that we could be on pace for a historic second quarter GDP contraction of potentially 50%. And unemployment, as we know, as recently as the May jobs report was marked around 13%. Yet the equity markets have continued their substantial rally since March 23rd. So what do you make of this from an economic perspective?
It's interesting, one, that the poll, and I think the polling's great because you get a nice temperature there. And I would concur with the 50%, right, that feel that the economy's actually even slightly better. And you said it earlier, Chris, thanks for observing it, that there is that power of relativity, right? What I did is I advanced the slides to a real simplistic line chart that looks at the market high on February 19th. And this is the S&P 500, right? Since we all talk about that. 3394, just to reacquaint the audience with that high. Obviously, we had the precipitous drop. That's when, there were all those questions. No one had answers. And then we came to this March 23rd low, as we know it now. 2232 was the level of the S&P at that point. And this was a bit dated, a month old. And if we continue this, obviously, we'd be up here now in that 3200 range, which we should update it because that would look like a V pretty much. But to the question, right, what do we make of this, that even if people feel like the economy is a bit better than they thought, is the market getting way ahead of itself? And the short answer would be yes. And what ends up happening, especially when you have these major economic dislocations, is the market is not operating in real time. What I mean by that is the prices of the stocks or even the bonds are not reflecting present day fundamentals or economic data. Because if it were, the economic data is really bad and historically bad. And you mentioned this negative 50%. GDP math is really funky, Chris, as you know, and that's why it looks so bad, because it looks at quarter to quarter and then they annualize it. So the number might be more like 12%. The GDP of the second quarter will be around 12% less than it was in the first quarter, and then you annualize it. The simple math is just multiply it by 4, and that's how you're going to get to that around 50% negative number. The media is going to have a field day with that number. The good news is once that number is reported, it's going to be out of date because it's all backward looking. And to your point, yesterday, the National Bureau of Economic Research officially told us we're in a recession. Again, it's all late to the party because the market is already up substantially. I'll point to one data point, right? Because yes, it's virus dependent, but it's ultimately economically dependent. And the virus is speaking to these reopenings. So if every state in the country is quote unquote reopening, even if it's 25% outdoor dining only, there's obviously every state has their own timeline here. The ultimate question is, how confident will Americans, and globally, if you want to go country by country, how confident will they be to get their family back to a restaurant or go on a plane on a vacation, right? Well, that's a real personal question, but that is the question, right? Because if the virus ends up being a bit better, if the employment report that we saw last Friday, now let me reacquaint some folks on the phone with that employment report, economists estimated we would have lost 8 million jobs in the month of May. Well, we didn't lose any, right? We actually ended up adding nationally 2.5 million. And about half of those were in the leisure and hospitality industries, hotels, restaurants. So those were the most hard hit areas. And obviously those jobs have come back very quickly. So it surprised a number of economists just how quickly a lot of employers rehired people. So I feel personally that when we get the June employment report, you're most likely going to see an even better improvement just by the sheer fact that we are reopening and people will eventually have the confidence to get out there and resume the lives they once had in February. Slowly but surely. Chris, we won't be at 100% of the economic activity, but no one says we have to be. This market is already appreciating the fact that in 12 months, 18 months, the situation will look a lot better in the near future than it does today. And that's all that's needed because obviously the stocks and the companies will be more profitable, not all of them, but certainly they'll be making more money, generating more revenue. And that's obviously what the stock market is appreciating literally on that very fact.
Yeah, very forward-looking, as it always is.
Always.
We have some, before we talk about investment strategy for these times, Brad, we've got a couple of fantastic questions that have come in.
Sure.
I'd like to get into them because I think they're really great because this is, of course, the world's greatest audience. What are your thoughts on the long-term effects on the economy of the increased debt due to the government stimulus? And it says, I feel like my grandchildren will still be paying for it. Amen to that. It's a loaded question, Brad, to an extent. And we could probably do an hour session on just that one alone. But how about some thoughts on just the, what are we at, 25 trillion and growing quickly of federal debt? What are your thoughts on that?
That's right. So, high level thoughts, without a doubt, we are going to be, this is to me, the greatest hangover that nobody would like to see. And even the great Milton Friedman, right, the great economist of the last 100 years said that, inflation is a very good thing. And it's much like alcohol, right? A lot of people enjoy alcohol until they don't. And too much of a good thing is not a good thing, i.e. this will be the hangover. And exactly what we're talking about here is if our debt will eventually get to 25 trillion, we know our GDP is around 20 trillion, and that's going to move a bit. But that's 125% debt to GDP. Today, we're probably just at the 100% line. But the short answer will be, when you're the United States of America and you have let's just say, currency and government debt that typically is the most popular on the planet, we are most likely not going to see near-term inflation in our economy, because the old saying goes that as I mentioned, if you have too much, let's just say, dollars, that could eventually dilute the value of the dollar, which means goods and services are worth more because your dollar is going to go less, right? It's not going to go as far. But that's only true academically if there's not a buyer on the other end of that dollar. And as I mentioned, the United States is the safe haven status in the world, right? It's basically where people go to, especially when you have these types of economic dislocations or these sky is falling moments. So inflation is not a foregone conclusion going forward. And ultimately, because the US does sit in that enviable position, I still feel like the US will continue to grow, albeit slowly, right? We are a very developed economy. So I still feel like we're going to continue to grow. Will taxes go up to help mitigate this debt? They most likely will. But that probably doesn't happen in the next 4-year term of the political regime, whether it's Joe Biden or Donald Trump. Pick your battles. I would say you are still going to need 60 votes in the United States Senate to reverse this tax cut that was made in 17. And that's going to be tough to come by, certainly for the Democrats, if that's how this all plays out. So lots we could say, but taxes going up, yes, it will happen, but not in the next 4 years. And even then, just how high they will go up is a good question. So there's a myriad of variables that go into that. Perhaps to short circuit it, we do not believe that the amount of debt that the United States government is employing or deploying should affect any asset allocation decision, whether it's in a retirement plan or in something outside of retirement. This should not affect your near-term allocation decisions, right? Companies will still be profitable if they're a high-quality company. Same thing with bonds. I wouldn't worry about inflation eroding your bond income. Maybe over the next 10, 15, 20 years, that's a different story, but not the next 3, 5, even 10. To us, this is going to be a peripheral distraction. I really feel that way. And that's not to discount the question, but it should not affect asset allocation decisions in the near term.
Yeah, fair enough. And regarding the debt picture too, there's I know some concerns, whether you divide it by red states or blue states or what have you. I know that there's some concerns about this next wave of stimulus or relief could go to bail out certain states that maybe haven't managed their financial affairs as well as others in the country. Do you have any insight as to have you any insight into that, as to what's happening on the Hill?
Yes, and what it's interesting because this all works together. If you think about what Congress had done, as I mentioned, very bipartisanly, which is interesting because it happened right after an impeachment, right? And we know how that all ended up. But yet Congress came together, both Speaker Pelosi, Senate Majority Leader McConnell, and they did it for the people. And not to get too deep into politics, I'll stay certainly apolitical. But this next round of stimulus, the first gleanings of it was a $3 trillion fiscal package. The House approved it, actually, because they are Democratic led. And this is not a shot to the Democrats, but what the Republicans are saying, certainly the Senate, the Republican-led Senate, they're saying $3 trillion seems a bit high, especially when $1 trillion of it was to go to state governments and local governments. And you're right, there's plenty of blue states, for one reason or the other, just tend to be in perpetual deficits. I mean, certainly the great state of Illinois is one of them, again, for one reason or the other. And the Republicans took issue with that. The other issue the Republicans have added is that, okay, yes, certain states need more money than others, but there was a bunch of COVID-19 money that was appropriated through the CARES Act, and there are plenty of states that have had almost zero cost fighting COVID-19, meaning certain states had no COVID-19 issues, or at least not to the extent that would require state aid, and perhaps that money could be reappropriated for other uses. So there's some moving parts. perhaps to your question, the Republicans would like a number closer to $1 trillion. Again, the Dems would like something closer to $3 trillion. I, for one, and I'm not going to, relinquish, or I should say, get too transparent as to where I sit here. But all I would say is, why don't we see how this plays out a bit? Our government affairs team has told us that it's probably going to be a mid to late July decision, and it will be closer to $1 trillion, maybe 1.5 at most for round 4. And I certainly hope that's the case, because as we've already talked about, right, let's just see how this plays out. Maybe the economy organically is starting to recover, and perhaps we don't need as much money as perhaps some think we do. So forever a very fluid discussion in Washington, D.C.
Yeah, believe it or not, it does take some time for trillions to get processed through the economy.
I believe it, Chris. I believe it.
All right, great, Brad. Let's talk a little bit about investment strategy
Sure.
moving forward. So, as you know, not everybody's the same. People have different risk profiles and time horizons. In your scenario modeling here, you could choose a path forward of playing offense, defense, or income. Could you explain those paths for our viewers and how it ties together with some of these notes about the shapes of both the economic and market recoveries?
You bet. So obviously the folks can see this slide here that has these 3 outcomes, right? Do we keep going higher? Do we actually see a retracement lower? Do we see sideways environment? To be fair, you could look at that same scenario, or those 3 scenarios, as playing offense, income, and defense. Now, and I've been doing this for a long time, you've been doing this for a long time, and I would imagine the folks on the phone, nobody's going to play just one of these, right? No one's going to just say, hey, let's go full on offense, even for those people who feel like the economy is getting better or the market is just right, meaning there's gas left in the tank. But they're also not going to, for those people who are a bit more worried about things, they're not going to go 100% defense. So as we always like to say, there's a combination of all 3 of these that continue to make sense. So what we've done is we've created this, kind of crude illustration, and I created it, so I suppose I could use that word. But this is a barbell. It's another fancy way of saying a diversified portfolio continues to make the most sense, right, going forward, because we don't know how things will end up. But the last thing we'd want to do is be too defensive, especially over these last 10 weeks, and yet the market has recovered and we've lost out on some gains, especially if you have a goal, i.e., retirement. And even if you're in distribution, and we know there's people on the phone that have stopped collecting an active paycheck or active income, that does not mean that obviously you go pure distribution mode and you go pure defensive, because let's hope you have a good long life ahead of you. So there is that longevity risk, and we know you want to continue to have some equity in the portfolio, as well as maybe bonds. We've added this orange, or this income side, because thinking of this sideways market, what we would offer in terms of a prescription is it's probably going to be some red, some green, but ultimately the market will probably move a bit sideways here until we have more clarity on the medical solution, right? I fully don't believe that we'll see a second wave. Now, what I mean by that, when it comes to this pandemic, we probably will see more cases. The media is starting to report additional cases. You'd have to imagine these demonstrations and these protesters, if you will. You'd have to imagine there's going to be some more cases. But we shouldn't be so quick as a society to say the virus is back in mass, because cases are a bit arbitrary, because we know the vast majority, 98+% of these cases, have not resulted in hospitalization, and they certainly haven't resulted in ICUs or ventilator. That to us is the greater statistic, right? What our ICU demand and what's the capacity look like? If there's enough capacity and the supply of intensive care units and just the supply of hospital beds remains higher than the demand, then this is something that our healthcare facilities should be able to work through. That's why the market going sideways, slightly up as we get closer to a medical solution makes sense. But income, i.e. bonds that pay some income, makes a lot of sense as well. So as we always like to say, and I know you guys do this for a living, Chris, for sure, let's get a path together, right? Let's have a diversified path, a mix of all 3 of these, and by all means, stick to that path to reach those financial goals. This is nothing new, but it's amazing how taking a page out of the old playbook continues to make sense, especially when we have perhaps a bit of opacity and less transparency on what we should all be doing during these periods. Even right now, if people think that the market is overpriced, well, keep your allocation to equity in case it continues to get richer, but at the same time, keep your allocation to defense in case you start to see a protracted pullback, which of course is not our base case, but then again, anything is possible. So this is our diversified approach, which I'm sure our folks have heard many a time.
Yeah, I really appreciate that. It's a tricky spot, right? Everybody's learning about shapes of recoveries: V shape, U shape, square roots, W's, right? And a lot of how you're allocated today is going, or how the market moves is going to impact how you're allocated today. Brad, thank you so much. Extremely insightful and helpful. I'd like to invite all of our guests here. Here we go. Share my screen. Guests today to visit the personal financial planning and asset management section of our website, finspireme.com. And what you'll see on the screen here is we encourage you to get your personal risk score. You'll see it right here, and where you can assess whether your portfolio is in alignment with your capacity to handle those risks that Brad was referencing. We're here for you today so you can invest fearlessly for your tomorrow. And so with that, we will close with our final poll question. Very simply, would you like us to contact you about any of the following: financial planning, investment management, business owner, financial solutions, corporate retirement plan consulting, etc. So as we gather up those answers, we'll certainly follow up with you individually. We want to thank you so much for participating today. We certainly look forward to continuing the conversation with you and maybe even Brad again soon. And we appreciate everybody's attendance today. Thanks so much. Enjoy the rest of the week, and we'll talk to you soon.
Thanks, everybody.